Someone in America right now is collecting over $131,000 a year in dividend income. Their federal tax bill? $0. Not in a secret offshore account, not through some shady loophole. It's sitting right there in the US tax code, completely legal, hiding in plain sight. And by the end of this video, you're gonna know exactly how to do it yourself. Now I know what you're thinking. Okay, that sounds too good to be true. So let me tell you right now, I'm gonna show you a real screenshot from actual professional tax software, numbers verified by a licensed CPA, that proves every single thing I just said. But first, I need to make sure you understand something that most investors get completely wrong. Because if you miss this one concept, you could be leaving thousands of dollars on the table every single year, and you'd never even know it. The IRS doesn't treat all dividends the same way. There are actually two completely different types of dividends, and the difference between them could cost you or save you tens of thousands of dollars a year. Think of it like two lanes on a highway. Lane 1 is the slow lane. These are called ordinary dividends. They get taxed at your regular federal income tax rate, the same rate as your paycheck. So if you're sitting in the 22% tax bracket, your ordinary dividends get hit at 22%. That's just like earning another dollar from your job. Lane 2 is the fast lane. These are called qualified dividends. And this is where it starts getting really interesting, because qualified dividends are taxed at a completely different, far more generous rate. And as you're about to see, in many cases, that rate is literally 0%. Now here's the question that determines everything for your portfolio. Which stocks put your money in which lane? And once you know the answer, that's when we can start building toward that $131,000 tax-free number. But there's one category of very popular investments that catches people completely off guard. We'll get to that in just a moment. Let's start with the slow lane, ordinary dividends. The most common culprits here are what are called alternative income asset classes. I'm talking about REITs, real estate investment trusts like Realty Income, BDCs, or business development companies like Main Street Capital, and MLPs, master limited partnerships like MPLX. Now here's something most people don't realize. The reason these asset classes pay ordinary dividends isn't random, it's structural. REITs, for example, are legally required to distribute 90% of their taxable income to shareholders. Because of how that income is classified at the corporate level, it flows through to you as ordinary income. Same deal with BDCs. The tax character of the underlying income passes directly to the investor. So when you're collecting that juicy 8 or 9% yield from a REIT in a regular taxable brokerage account, the IRS is treating it exactly like a paycheck. That's the slow lane. Now the fast lane, qualified dividends. Generally speaking, the vast majority of regular S&P 500 stocks pay qualified dividends. Think Coca-Cola, Johnson & Johnson, Apple, Altria, your classic blue chip dividend payers. These are the stocks that, under the right circumstances, you can collect income from and pay literally nothing in federal taxes. Quick rule of thumb you can use right now. If it's a REIT, BDC, or MLP, you're probably in the slow lane. If it's a regular corporation listed on a major US exchange, you're almost certainly in the fast lane. And for ETFs, most popular dividend ETFs like SCHD or VYM are primarily qualified, but always double-check the fund's distribution breakdown on their website to be sure. Okay, so now you know the difference between the two lanes. Here's where it starts getting really wild, because the fast lane has a speed limit that most investors don't even know exists, and that speed limit is 0%. Before we get to the 0% strategy, we need to quickly cover how income tax brackets actually work, because there's a misconception here that I hear constantly, and it matters for everything that follows. The US uses what's called a progressive tax system. Picture a ladder. Each rung is a tax bracket, and you only pay that bracket's rate on the income that falls within that rung, not on your entire income. So in 2026, if you're single and making $100,000 a year in ordinary income, you don't pay 22% on all of it. You pay 10% on the first $11,925, then 12% on income up to about $48,475, and only then 22% on the amount above that. Your actual effective tax rate, the real percentage you're paying overall, ends up somewhere in the mid-teens, not 22%. That's a really common misconception. Now, if you're married filing jointly, everything essentially doubles. That same $100,000 of ordinary income, the highest bracket you'd even touch is 12%. Marriage can genuinely be a tax advantage in this country. But here's the thing about ordinary income. Even with progressive brackets, high earners can still get hit at 32, 35, even 37%. And on top of that, W-2 wages get hit with FICA taxes, that's Social Security and Medicare, an additional 7.65% that most people completely forget to factor in when they think about what they're actually taking home. Qualified dividends, they have neither of those problems. No FICA taxes and a completely separate, far more generous set of tax rates. Let me show you what I mean. Here's where things get genuinely exciting. Qualified dividends are taxed under the capital gains tax schedule, not the ordinary income brackets. And in 2026, the rates look like this. If you're single and your total taxable income is under $49,450, your qualified dividends are taxed at exactly 0%. Not 5%, not 3%, 0. And if you're married filing jointly, nearly $99,000 of qualified dividend income can be collected completely free of federal taxes. I want you to really sit with that for a second. Nearly $99,000 in dividend income, zero federal taxes. Not in a retirement account, not in an IRA, in a regular taxable brokerage account. This is not a trick. This is the United States tax code. Compare that to ordinary income, where the top rate can hit 37%, or compare it to your job, where wages get hit at your regular rate, plus that 7.65% in FICA taxes. Qualified dividends skip all of that entirely. But here's the thing, we haven't even talked about the standard deduction yet. And when you stack that on top of the 0% qualified dividend bracket, that's exactly how you get to $131,000 in tax-free income. And I'm going to show you the math right now. All right. Here's exactly how this works, and I want to be really clear. I had a licensed CPA, a certified public accountant, run these numbers through actual professional tax software. This isn't a theory or a loophole someone found on the internet. These are verified numbers from a real tax return scenario. The strategy works because the tax code layers two things on top of each other. The government lets every taxpayer earn a certain amount before they even start counting it as taxable income. That's called the standard deduction. In 2026, thanks to recent legislation, the standard deduction increased. For married couples filing jointly, it's $32,200. For single filers, it's $16,100. So what does that mean in practice? It means the first $32,200 of dividend income you receive as a married couple is essentially invisible to the IRS. They don't count it. It doesn't exist as taxable income before the math even begins. Now you add that on top of the 0% qualified dividend bracket, which covers up to $98,900 of taxable income for married filers. So the total math looks like this. $32,200 from the standard deduction plus $98,900 from the 0% qualified bracket. That's $131,100 of qualified dividend income, and your federal tax bill is $0, confirmed by a CPA, backed by the IRS tax code. Now here's the comparison that I think will really put this into perspective. To bring home $131,100 from a regular W-2 job, after income taxes, after FICA, you'd need to earn $165,000 in gross salary. Qualified dividends are literally more tax efficient than your paycheck. The tax code was not written for people who trade hours for dollars. It was written for people who put their money to work. And if you're single, you can collect $65,550 in qualified dividends and pay $0 in federal taxes, which is the equivalent of earning an $85,000 salary without giving the government a single dollar. And if you're over 65, it gets even better. As part of recent tax legislation, a temporary senior deduction was introduced for 2026 through 2028. If you're 65 or older, you can deduct an additional $6,000 on top of the standard deduction. And if you're married and both of you are over 65, that's $12,000 extra on top. What that means in real dollars, some seniors could receive well over $131,000 in qualified dividends and still owe absolutely nothing in federal taxes. The threshold just keeps climbing. Now, I know exactly what some of you are thinking right now. What about state taxes? What about inflation? What if I have other income sources? Great questions. Let's knock them out one by one. First, state taxes. I'm going to be straight with you here. Everything we just talked about covers federal taxes only. Most states will still tax your dividend income on top of this. That's just the reality. But 7 states charge zero state income tax, none at all. And this list is worth knowing, especially if you're thinking about where to retire. Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. If you happen to live or retire to one of these states, the entire $131,100 strategy becomes truly zero tax. Federal zero, state zero. That's $130,000 a year in income, and you're not writing a single check to anyone. I'm not saying you should uproot your life just for tax reasons, but if you're in retirement planning mode and deciding between 2 locations, this could be worth tens of thousands of dollars over the course of your retirement. It's at minimum worth knowing. Second, what about inflation? Won't $131,000 buy less and less every year? 2 reasons this concern basically disappears with the right dividend strategy. First, the tax brackets and deductions we talked about are adjusted for inflation every single year. You actually saw this happen in this very video. The thresholds moved from 2025 to 2026. So the $131,100 number isn't frozen. It rises automatically over time. Second, and this is the one I really want you to hear, the right dividend stocks don't just keep up with inflation, they absolutely crush it. Take Visa. Over the last 5 years, their dividend has grown at a compounded annual rate of 15% per year. 15%. Inflation typically runs at 3 to 4%. In 2015, Visa was paying 50 cents per share in dividends. By 2025, that was $2.44, nearly a 5 times increase in a single decade. Your purchasing power didn't just hold, it exploded. This is why dividend growth investing, specifically selecting stocks with a long, consistent record of annual dividend increases, is such a powerful long-term strategy. Your income grows automatically, year after year, without you adding a single dollar to your portfolio. The dividends compound, the raises come like clockwork, inflation becomes almost irrelevant. Third, what if you have other income? Social Security, a pension, part-time work. Does that blow up the whole strategy? Not necessarily. Here's the key thing to understand. What matters is your total taxable income, not just your dividends in isolation. So let's say you're married, you're collecting some Social Security, you're doing a little part-time consulting. You'd simply take the $131,100 threshold and subtract whatever other taxable income you have. The 0% bracket doesn't disappear the moment you have any other income, it just shrinks a little. You still have room, you just need to know your specific numbers. This is exactly why working with a CPA on a strategy like this is worth every dollar they charge. The math isn't complicated. Having someone run your personal scenario and make sure you're optimizing correctly, that's where the real money gets saved. Now, what if you're actually generating more than $131,100 in dividends? Does the whole thing fall apart? Not even close. Say you're married and you're pulling in $150,000 in qualified dividends, almost $20,000 over the tax bracket threshold. Only the amount above the threshold gets taxed at the next rate of 15%. So your total federal tax bill on $150,000 in dividend income is just $2,835. That's a 2.4% effective tax rate on $150,000 of income. Let that sink in for a second. 2.4%. If that same $150,000 came from a W-2 job, you'd be looking at a 22 to 24% marginal rate, plus 7.65% in FICA taxes on top. We're talking about a difference of tens of thousands of dollars. Same income amount, completely different financial outcome. That's not an accident. That is the tax code deliberately, intentionally rewarding investors over wage earners. Okay, and now here's the question I know is sitting in the back of your head, the one the internet never seems to actually answer. How much money do I need invested to generate $131,000 a year in dividends? Let's do the actual math. If your portfolio generates an average dividend yield of 3%, which is conservative for a quality dividend growth portfolio, you'd need roughly $4.4 million invested to hit $131,000 annually. At 4% yield, you're looking at around $3.3 million. At 5%, which is very achievable if you're blending in some higher yield blue chips alongside your dividend growth names, you'd need about $2.6 million. Now, before you close the app because those numbers sound intimidating, I want to be really clear. That is the destination, not the starting point. Nobody builds this overnight. The people who get there do it through decades of consistent investing, reinvesting every dividend they receive, and selecting stocks that grow their payout every single year. And here's the beautiful part about dividend growth investing specifically. Every time a company raises its dividend, and the best ones do it every single year like clockwork, your income goes up without you outing a single dollar. That's compounding that works while you sleep. The strategy isn't complicated, the discipline is the hard part, but the math is always working in your favor. Here's what I want you to take away from this video. The United States tax code was not written for people who trade their time for money. It was written deliberately for people who put their money to work. $131,100 a year in qualified dividends, zero federal taxes in a regular taxable brokerage account, verified by a CPA, backed by the IRS, available to any American willing to build towards it. The neighbor who earns $131,000 from their job is paying a combined tax rate that could hit 30% or higher when you factor in everything. You, collecting the same income in qualified dividends, potentially pay nothing. Same dollar amount, completely different financial outcome. The only difference is knowing the rules. There are two versions of financial life in America. One for people who earn income with their time, and one for people who earn income with their money. The rules of those two worlds are completely different. And now you know which side you want to be on. If this video changed how you think about money, I'd really appreciate a like. It genuinely helps this channel reach more people who need to hear this. Subscribe if you haven't already, and drop a comment below. What's your current dividend yield, or what's your target for retirement? I read every single one. I'll see you in the next one.